Hello, everyone. Today on the Final Bar, another V-shaped day for the markets, but changing going into the close. The S&P once again getting repelled at 4,500. We'll talk about the energy sector at the top of the list, other defensive sectors as well. Also, one key FANG stock breaking down. Sentiment indicators will be on the list as well. Are they still bullish? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. Once again, instead of coming to you from Redmond, Washington, we're here remotely in Las Vegas for the Money Show's Investment Masters Symposium. A lot of fun we've had here in Vegas the last 2 days. We've been responsible overall, but we also had a really good time connecting with a number of stock charts users who attended the conference today. I did a 2-hour masterclass sharing a checklist on how you analyze stocks using the technical toolkit. Some really good questions, just reinforced to me the value of the type of things we talk about, the charts and the approaches that we advocate on the Final Bar. It's all about improving your situational awareness, really connecting to the markets by focusing on the evidence the markets provide back to us in the form of price and volume, breadth and sentiment, trend and momentum. We'll do our best, as always, on the Final Bar to share with you the latest observations we're making and really encourage you, empower you to make better decisions using the toolkit of the technical analyst. Today looked a lot like yesterday until the last hour and a half of trading. I was sort of preparing one of my 3 and 3 charts to show how similar today was versus yesterday. And then everything changed, which is the reality of equity investing, right? The markets turned very quickly around 2:30 Eastern into the close, really accelerating to the downside, pushing the major averages back to the lows of the day. Let's take a sense of where things are at, look at the aftermath, and what long-term shifts may have occurred in terms of the day-to-day price action. Let's get right to our market recap and focus on what we learned today. First, I'm going to ask you a question about one of those FANG stocks, Apple. Where will Apple be 1 month from today? We asked this question recently on our social media accounts, of course, on our YouTube channel. So make sure you follow us and subscribe where you can. 10% higher, 10% lower, or within 10% of current levels. Almost half of you agreed with that third option, basically saying 1 month from today, which would be right around Labor Day, right? Right after Labor Day, early September. Most of it are actually almost half of you, 46% said within 10%, 23% at least 10% higher, 30% at least 10% lower. So quite a distribution between the three. Let's look at the chart of Apple and just sort of think about what that kind of move might be. Now, it's interesting that we're asking this question after Apple gapped lower, and what happened through the course of, end of last week into this week is you're seeing this, gap lower, the Apple going below the 50-day moving average and then continuing to distribute, right? So instead of investors buying in on short-term weakness after earnings, you're seeing continued downside pressure as a chart like this continues to go down. Now, just quickly visually, if you look at where we're at now, 10% higher actually puts us back in the range of previous highs. That's around 195. 10% lower below current levels would basically be a test of the 200-day moving average. What a great sort of framework, a great good stock to ask about, because question is, do we retest previous highs or do we test the 200-day moving average? Which one first? Or do we stay within that range? I would 100% agree with those of you that said in the middle. I think when all is said and done, there's a bit of a dislocation. Apple goes down 10%. That's a pretty big hit to the XLK because it's about a quarter of the weight of the technology ETF. Certainly a hit to the NASDAQ 100 and the S&P being the largest, certainly one of the largest names, a mega cap name. 10% further down would be a big deal, but that could be the end of the move, right? And then we sort of come back and within that range. I think that's probably a safe bet. I don't know if it's a safe bet, but that's probably what I would answer. Thanks for answering that poll, by the way. Keep answering, and we appreciate you encouraging you to think about how those poll questions help you use technical analysis to answer those questions more effectively. Let's keep going with our market recap. As I mentioned, it was a V-shaped day until it wasn't. All of a sudden, we have sort of this squiggly line pattern, I guess, the zigzag pattern. I'm not sure what I would call this, but if you look at what happened through the course of the day today, it was a tale of 3 phases, right? Distribution out of the open right around lunchtime. We rally back to retest 4,500, only to be repelled and retest the lows. That is the nature of the markets here in August 2023. The sell-off in the afternoon pushed the S&P down about 0.7% from yesterday's close. The S&P, again, bouncing down off of 4,500, finishing the day around 4,468. The NASDAQ composite down about 1.2%, so a little bit further. The Dow down as well, only about 0.5%. So we've talked about that idea of growth rotating lower, of some of the value-oriented sectors, the cyclical leadership doing a little bit better. It's once again what we saw through the course of the day today. Mid caps, small caps, all down as well. The VIX, one of the few signs of life on this front page, the VIX really was essentially flat from yesterday. Finished the day around 16. That's after bouncing, when the market sold off going into the close, volatility spiked a little bit. So we got just above 16, which is pretty much where we ended the day after yesterday's trading session. Looking at the bond markets, mixed, to be honest with you, sort of a choppy, consolidative feel to the tape going into tomorrow's latest inflation data. And we think about, bullet points through the week of some of those key moments in the latest inflation reading, certainly pretty important. No Fed meeting in August. So the next Fed meeting after July's rate hike would be in September. The market is pricing in no additional change to the Fed's target rate through the remainder of 2023. That can certainly change. And I would argue that an inflation number comes in way higher than expected tomorrow. I think the market could quickly price in the need of the Fed to take additional action. But for now, sort of the general consensus is wait and see mode in the short term. And over time, it's certainly been pricing in that the Fed's actions in raising rates have certainly started to work. The economy has been slowing down as expected. And CPI number tomorrow could either further validate that thesis or completely change the game, which is kind of why we're in a choppy question mark sort of move today. 10-year and 30-year points on the yield curve, the longer end of the curve, coming down just a bit, but slightly. The 10-year yield still above 4%, 30-year yield around 4.18, just below 4.2%, and 5-year yield, short end, up just slightly. So it's sort of a general flattening of the curve, but overall still very similar to what we've seen. No real change in the dollar as well. So again, I think of sort of a wait and see mode for a lot of asset classes today. Commodities overall moved higher, but that was really the energy side of the ledger that was really getting the upside movement. The energy sector, as I mentioned, the top performing sector. Gold and silver both down about 0.5% today. So the GLD and the SLV continuing to distribute. Earlier today, I was doing the seminar here at the Money Show, and I was looking for an example of charts in a distribution phase, or charts having recent rotations lower. And the two examples I came up with were Hershey's and Newmont Mining, right? So it tells you kind of the nature of the market right now. Staples have been a pretty consistent underperformer, and gold stocks, the GDX and others that we've highlighted recently, continuing to struggle a little bit. I wouldn't be surprised at some point if we see a resumption of the uptrend on gold. Gold is not far below all-time highs, around $2,100 an ounce, but it's certainly come off of those highs here in recent weeks and months. Finally, looking at cryptocurrencies, again, kind of mixed. Bitcoin rolled over, Ether as well, going into the equity market close. Bitcoin currently just below 29,380. That's down about 1.3% from yesterday, and Ether just below 1850. Looking at the 11 S&P sectors, kind of a familiar pattern in terms of energy at the top of the list. Now, it's so interesting as we're talking about the rotation lower in growth. We're talking about stocks like Apple and Microsoft that had incredible runs in the first half of the year, really starting to rotate lower and show further distribution through the course of this week. Energy, the opposite, one of the underperforming sectors year to date, really improving over the last 6 to 8 weeks. And I wouldn't be surprised if energy continues to move higher. I think higher oil prices are in the cards, and as a result, energy most likely, that's a nice tailwind to the energy complex. So the XLE today up 1.2%, that far outpaced everything else. Number 2, 3, and 4 from the top of the list: real estate, utilities, and consumer staples. And if you ask me to list the 3 most defensive sectors out of nowhere, I would say real estate, utilities, and consumer staples. So by the end of the day, sort of a defensive feel. Besides energy, it was more defense kind of working. Now the FANG sectors were at the bottom of the list, as a lot of the previous growth leadership continues to push lower. XLC, XLY, XLK, all down over 1%. Technology leading the way lower, down 1.3%. I'll highlight here in a moment some of the semiconductor stocks really starting to feel the pain this week. Looking at a daily chart of the S&P, I think no real change to the general sort of observations we've been making. I think the larger trend is still in place. But what you have to remember is when I'm thinking of the larger trend, that's assuming we could move all the way down to 4150, 4200 and still be within a larger uptrend. That would be sort of at the lower end of a channel, which you would take from the October lows, take the November and February swing highs, the March lows, sort of think of this as a general channel. We were really overextended through above the upper end of that channel a couple of weeks ago. Now we're rotating back toward the middle of the range, which means we can get all the way down to around 4150, 4200 and still be within a well-defined uptrend channel. And that shows you how much downside we could have in the S&P and the NASDAQ. Short term, obviously quite weak, but long term still just fine. And I would, my general base case for the markets here is weakness in August and September, strength in the fourth quarter. We're starting to play out more and more in line with that general thesis. I would say all eyes still on the 50-day moving average. Back of the envelope, when you're looking at a chart like this that has had a really good run, making a new swing high, when we pull back, do we hold the 50-day moving average? That's what happened in April and May, which is one of the many reasons why it felt like still a very constructive pattern. Does that happen here? And if we break something like 4,400, we're below the 50-day moving average, that's where I think you really need to think about further downside retrenchment, what your portfolio might look like, and what sort of steps you want to take to protect yourself for downside exposure, either taking profits, using options and other things, protective puts, for example, to make sure that you have a clearly defined downside risk for any positions that you're holding for the long term. I was almost going to show this chart, the VTI. VTI is a broad market ETF, kind of similar to the S&P 500, to be honest with you. And almost one of my 3 and 3 charts was going to be this one, because about an hour and a half ago, as I'm preparing for the show, I'm noticing how today's candle looked almost identical to yesterday's. I was thinking, oh, wow, how interesting is this? So we have a couple days in a row of these hammer candles where we open, we trade lower, but we close back toward the highs of the day. Lesson learned, I think, for many of us on a day like this is remember that a candle pattern is fluid until the close, right? Until you hit the closing bell, until the fourth quarter is done, you can't determine what that candle shape is going to be. And the candle looked very different for today about 90 minutes ago. Now, all of a sudden, it's more finishing at the lows of the day. Instead of looking like a hammer candle, it's furthermore showing distribution. It's showing an additional down day within a downtrend that started about a week and a half ago. So overall, I think what started to look like a fairly constructive, sort of encouraging pattern going into tomorrow's inflation report, I would argue this is more of a struggling market, really not finding a foothold just yet. Now, having said that, with the remainder of our time together with the market recap, I wanted to talk about sector distribution. I'm going to show Julius de Kempener's relative rotation graph. Again, his show Sector Spotlight does a great job of highlighting this methodology and how to use it. So go there if you're looking for more detail on how to use this relative rotation graph. But when I think about a rotation away from growth and into value, this is what things looked like at the end of June. You can see growth offense like consumer discretionary and technology leading and getting stronger. Some of the defensive and cyclical leadership like energy going down and to the left. Look at how this has literally rotated in the last 6 weeks. Now you see the growth leadership rotating down on the weekly RRG and all the cyclical leadership starting to improve like energy, industrials, materials, financials even. If you look at the daily chart, you can see a little bit of it as well. And one of the things that I would highlight is the difference between two sectors. Look at energy, which again has lightened up a little bit, but still the strongest performing sector using the daily RRG up and to the right, and in the strongest position in the leading quadrant. Compare that to what we see from technology, which is in the lagging quadrant and heading southwest, what I call the direction of deterioration, weakening momentum, and it's getting stronger to the downside. So energy has been working, technology has been struggling. And we've seen that from the mega cap names, Apple, Microsoft, some of the charts that we've highlighted in recent week. Today, as I mentioned in the introduction, one of the FANG stocks, or what I call the phenomena stocks, which is sort of the FANG plus a couple other FANG-like names that I like to track. NVIDIA, the latest stock to fail to hold its 50-day moving average. And one of the things we talked about as we look at those 8 sort of leadership growth names Do they hold the 50-day moving average in a pullback scenario? Microsoft, the answer has been no. Apple, it's been no. Now, in other sectors, it's been okay. Names like Alphabet and Meta and others have held their 50-day moving average. NVIDIA today closing back below the 50-day, down almost 5% today. The semiconductor space got hit pretty good today, leading the way lower. Again, this is one of the many reasons why the technology sector was at the bottom of the list. What concerns me about a chart like NVIDIA is we're failing to hold the 50-day. And in a consistent uptrend, in a well-established bullish phase, you look for pullbacks to a 50-day, and then you rotate higher. Going into tomorrow, going into Friday's session, I'll be watching the chart of NVIDIA to see if we get any follow-through, right? Once you break a level like the 50-day, do you see further follow-through? For now, this is a chart more in distribution than anything else, and I'm concerned about a big mega cap semiconductor name like NVIDIA struggling to hold support. Now, other semiconductor stocks struggling as well. This is Broadcom, AVGO, also going below its 50-day moving average. Another implication of charts like this going below their 50-day, one of the breadth indicators we highlighted yesterday on the show, the percent of stocks above their 200-day and above their 50-day moving averages. Names like NVIDIA and Broadcom and other growth names getting below their 50-day is going to make that indicator go very quickly below that dreaded 50% level. I actually didn't check going into the close today if that did get below the 50% level. So let's check that together here. This is looking at the S&P 500, not quite. So it's still about 59% of the S&P above their 50-day. And again, while some of these names broke down pretty good, the average stock was holding in there okay. A lot of that weakness came in the last hour and a half of trading or so. So still in a bullish phase relative to what we talked about yesterday. I think no real change there. It's just these indicators are getting less and less lights out bullish and more cautionary, telling you we're probably in the later innings of the baseball game here. Now we have stocks reporting earnings. This is that's not the chart I wanted. Here's the chart of Disney. And Disney's reporting after the close today. We're sort of winding down earnings season. So, sort of getting to the end of that period where we're going to be thinking about earnings as a main contributor to movements. Sort of happens cyclically, right? Of course, once a quarter. Disney just reporting today down about 1.7% after hours, currently trading around 86. But after hour sessions usually less liquid and a little noisier as the company reports earnings and then does their earnings call. That's when things really start to move. So I think it's a little too early to pass judgment on reaction. But for now, the stock's selling off after the close, currently around 86. Now, the concern with Disney is that we are below two downward sloping moving averages. We gapped higher today, but closed lower. We've tested the 50-day a couple times and have failed to hold that. So I'm concerned on charts like this that are not able to find a footing. The buy thesis or the bullish thesis on a chart like Disney is it's testing a key support level. And that's what I would be thinking about going into earnings. If earnings disappoint and Disney closes below 85 tomorrow, that makes a new 52-week low. There's not much to get excited about from a technical perspective if we're unable to hold that December low. That low is in play, I think, today into tomorrow. We'll see how the remainder of this week goes after Disney's earnings are digested. That's our market recap for today. Again, some interesting looks at some of the key stocks in the news and in the move. And I would say that some of those growth areas of the market really continue, I think, to deserve your focus and attention. We're going to do a segment here in a moment called Getting Sentimental. We're digging into some market sentiment indicators. Before we do that, just a friendly reminder, we love to hear from you. We've got some great feedback on the show. I met some of our Stock Charts TV viewers and longtime followers of the Final Bar here in Las Vegas. We would love to hear from you wherever you're at geographically. Best way to get your questions, and questions are most welcome because that's how our mailbag gets full, and that's provides us some commentary on Friday's show, our next mailbag. Email is the best way to get your questions to us, thefinalbar@stockcharts.com. On Twitter /X/whatever we will call it these days, just tag us in a comment at FinalBarSCTV. And on YouTube, of course, just drop a comment below the video you're watching. We'd love to hear from you. Hope to answer your question in our next mailbag segment on Friday's show of this week. Let's continue today's show looking at market sentiment indicators. Our segment, Getting Sentimental, one we used to do very often. Excited this week, now that we're remote and thinking about some segments to do. I'm excited to bring back some of these ones like breadth and sentiment indicators. We try to address them randomly on the show, but this has really given me and I hope you an opportunity to revisit them more consistently. We'll think about how we can incorporate them into the show going forward. Of course, when I talk about sentiment, I always want to start with volatility, and the VIX is really the main way that I like to measure volatility. There are a number of different ways we could do it, of course, and a number of ways we can measure volatility of a particular instrument. If you trade options, you're probably very familiar with measures of volatility and what they may represent. The VIX is more of a general measure of volatility, and I would caution us from calling this the fear index or the fear gauge. I know that's what it tends to be described in the media. But to be honest with you, I don't think it measures fear as much as it measures uncertainty, which are similar but not exactly the same, because the markets can go up on higher volatility. They can go up, but there's just less stability behind that rally. And the markets can go down on lower volatility. Both of those things can certainly happen. But generally speaking, there's that inverse relationship. And that's why people like to call it the fear gauge. Now, if you look at what has been happening with the VIX recently, we have been at extreme lows compared to the last couple of years. The last time we were down anywhere near these levels was in 2021. And that was when we had a pretty long-term, consistent bull market phase. Volatility was fairly low, sort of in that 14, 15 to 25 range. And that was sort of this period here. This is during the sort of mid to late stages of that bull market coming off of the COVID lows. The market continued to push higher. The initial high volatility around the COVID, beginning of the COVID area, it's sort of to alleviate, still pretty high now relative to today's levels, but at the time was really a lessening of volatility. 2022, of course, the market pushed lower on high volatility, and those big down thrusts when investors are getting nervous, when they are unwinding positions very quickly, this tends to create a spike in volatility. And the VIX often got up into the mid 30s, highest range. It got up almost to 39 in January of 2022. And on the lower range, it was lower end of the range, it was around 20. Now, I have that as sort of the main line on my chart here because back of the envelope, when the VIX is above 20, I think of that as a high volatility environment. When the VIX is below 20, I think of that as more low volatility. So really, since the spring of 2023, we've been in a low volatility environment, and that VIX has continued lower. Now we're down to levels that we haven't seen since like 2017. You have to go back into the sort of cyclical bull phase of the 2010s. To those nice long up years on low volatility. And that's kind of what the VIX looked like back then. Now, the question I would have, or I guess what I would be looking for on a chart like the VIX in this environment, when you think about seasonal tendencies where August and September tends to be a little weaker than normal, would be the market pulling back, of course, but volatility spiking. And this is one of those main measures that I would look at to see if the sentiment of the market or the character of the market starts to change. This is what's interesting to me over the last week or two, is you've seen the VIX go from around 13. We actually got down to a 12 handle there a couple of weeks ago, just barely. And now we've spiked up to 18, which is where we're at one point this week. We've settled back down. We're currently around 16, but still we're bouncing off of those lows that we've seen. That's the pink shaded area here. The higher volatility gets from this point on, I think the less and less likely the market is able to find a footing, and the more likely that we're in sort of a 5 to 10 to 15% sort of pullback phase in the markets. Higher volatility means higher uncertainty. And in this case, I think it does represent fear, or certainly the fear of losing as the market would go down. Let's continue. Now, the other thing we can do, or other ways we can do, we can look at options. We can think about the VIX. We can talk about put-call ratios, which we'll get to if we have time. But we can also look at survey data. Now, survey data, I sort of have a love-hate relationship with things like the AAII survey. I think it's fascinating for investors to be able to report what they're thinking about the markets and use that. Something like the AAII survey, which has been going for decades, gives you a really good long data series to analyze and to try to think about what the sentiment is now versus what it's been. But what you have to remember, again, is a survey of any sort is only as good as the responses, the data that you're getting. And you have a relatively small number of individual investors. Most of them experienced investors is the way I would describe it. So not that there's anything wrong with that, but it's really only giving you a subset of the investing community. So with any survey data, like the Investors Intelligence, with Market Vein, with something like the AAII survey, anything that's survey related, I think you have to take with an asterisk of sorts, of just remembering it's as good as the data that we can get. Now, having said that, look at where we're at right now and look to the left and see when we've been at these previous levels. when I look at the bullish reading, and this is actually last week. We haven't gotten this week's reading just yet. That will be reported tomorrow. So on tomorrow's show, on Thursday's show, we can give the most latest weekly reading. So as of last Thursday, the AAII bullish reading was at 49%, which means 49% of the respondents said they're bullish on stocks for the next 6 months as opposed to bearish or neutral. There's only around 21% that were bearish. So again, well over a 2-to-1 ratio of bulls outnumbering bears. And at the bottom, you can see the spread, bulls minus bears net difference, which are heavily, and which are more heavily represented. And if you look at the current bullish reading and look to the left, if you look at the current bearish reading and look to the left, look at the spread between the two and look to the left, here's what you're going to find. The last time we were in a similar position, almost there in November of last year, which is at the end of that move, but it looks a lot more like the early half of 2021, which was more of the beginning of a much more consistently strong bull market phase. Now, while there's no guarantee that we would have a repeat of that sort of pattern here, it does tell me that investors are currently quite bulled up through last week. Now, I think this could be one of those weeks where you see kind of a downward shock because many that have been bullish now have experienced a bit of a drawdown and maybe a lot less optimistic, just given the pullback that we've seen in stocks like Microsoft and Apple. It's easy to be pretty bullish when Apple continues to make new highs, but when that stops happening, I think there's a little more nuance, right? A little less obvious sort of momentum behind the market shift. I wouldn't be surprised if this comes down a little bit, but it's worth noting these are sort of at the upper extreme of bullish readings that we could get from the AAII survey. Now, when I talk about maybe a downward shock in that particular survey, that's because we're seeing it elsewhere. Here we're looking at the Name Exposure Index. This is the National Association of Active Investment Managers. So it's a lot of money managers, wealth managers running decent books, and they get a survey where they basically can say what their exposure is to equities. So the answer can go from double long, 200%, to double short, 200% short, and anywhere in between. And it aggregates all those responses into a net number. If you look over the last 2 weeks, this number was just over 100%, which I would consider sort of the extreme bullish reading. That means that altogether, the respondents in the survey are leveraged long. They're really bulled up, and that's reflected in the positioning, at least that they're describing in the results of the survey. Look what happened in the last week, though. We went from about 102, 103% long to down to 78% long just in the last week. Now, again, that's not a horrible bear market number by any means, but it shows you that respondents in this poll, money managers rotating lower, are taking at least some of the upside bets off the table, taking a little bit of a risk off from a very risk on position to a little less, still sort of higher than average, but not by much. And I would be watching these sorts of surveys to see if you get that rotation away from extreme bullishness down to lower levels. The reality with these sort of surveys is you're really making a contrarian bet, right? When everyone's bullish, then the anecdotal last buyer has bought, and who's left to push the price higher? And that's the concern when any of these indicators get too extreme. I think we've seen that now in the last couple of weeks. We may be seeing a rotation lower in some of those sentiment indicators soon. Last chart we can do here is looking at, in terms of sentiment, is looking at the put-call ratios. I was actually asked about this just recently. One of the comments on our YouTube channel was about the put-call ratios and how we use them. I don't have time to get too much into the details here, but I will tell you that the put-call ratio is one of the ways we can use the option market to measure sentiment, because you're basically looking at positioning, right? Are investors in this particular area of the options market, depending on what put-call ratio you're looking at, are they more on the put side or the call side? Now, again, there's a little bit of a nuance to this for sure, because what that position actually represents, what bet is being taken, has to be assumed. Also, you have to remember that the 0 days to expire options, the 0 DTE options, have certainly influenced these indicators. This is when they came out at the end of last year. You can see how the data series got super noisy, and all of a sudden the put-call ratio started to spike. And a lot of that was related less to, I would argue, a sentiment shift of some sort, but more the market digesting this new whole area of market activity. Options market has changed. It's different now than it was a year ago, and that's the reality. Having said that, earlier in July, the put-call ratios were incredibly low relative to the historical average. If you look at the raw data there in gray, you can see that the total put call ratio, which includes index options and equity options, was down to 0.75. The last time we were there was in November of last year. And before that, you have to go back to the end of 2021 when the put call ratio was that low. And again, tends to be an inverse relationship. When the put call ratio is very low, tends to indicate high likelihood we're nearing the end of a bullish move. Put call ratio is very high, usually means a pullback has run its course and we're most likely at the end because of that contrarian positioning. So we went from a very low put call ratio starting to rotate higher, which is pretty consistent with the end of a bull market phase. You can see on the equity only put call ratio, that same sort of pattern. The ratio is very, very low, really one of the lowest readings we've had in the last 18 months, pretty commonly found at the end of a bull market phase. So I think some of the sentiment data is really sort of lining up with that idea that the trade that has run its course, that growth-led bull market, is certainly changing. Now, how investors rotate and what that means for our benchmarks, I think those are the main questions we will be trying to answer, and I hope you will be trying to answer as well using the power of the Stock Charts platform. And with that, we have to wrap the show. Let's go right to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. Again, I almost had this first chart looking at the VTI and the candle pattern. It changed quite a bit. So what I wanted to do was just show you intraday what happened today versus what happened yesterday. This is a 5-minute chart of the QQQ. I rarely show intraday charts on this show because that's not the time frame we're dealing with as much. I try as much as possible to get out of this time frame and think about what today's move means relative to the longer term timeframes. That's why we look at a little more daily charts and some weekly charts as opposed to a 5-minute chart like this. But I think it's helpful to show how both today and yesterday had that initial sell-off after opening and trading lower right out of the open until sort of the 11, 20, 12 o'clock range. Sort of just before noon on both days, we made a double bottom of sorts. And then from there, we rotated higher. So as about 2:30, it's looking like a reprint. It was a deja vu day of sorts. But then look at how things changed. There's a behavioral bias called recency bias, or the recency effect, where we assume whatever has just happened is going to continue to happen. And it often comes up. And I caught myself doing it as I was preparing for the show. I'm like, all right, I saw this yesterday. Here's what's happening. It's another V-shaped day. What does this mean? I start thinking of this whole narrative. Then I watched as I'm preparing for the show as the market just rotated lower. So just because something happened yesterday a certain way does not mean the same thing is going to happen today. That is a common issue I think investors run into. And if you're looking at just the simple pattern of highs and lows, you're looking at the momentum with what the RSI is doing, which remained above 50 for the last hour of trading yesterday and broke below 50 right around 3 p.m. today. You look at the PPO, or the MACD indicator, which remained bullish through yesterday's close, turned negative today. All the signs told you about a change of character going into the last 90 minutes. Really helpful if you're on a shorter term time frame to think about how these patterns are evolving and don't assume that any one day is going to be like any other. Chart number 2 is looking at the relative rotation graph. And one of the things we have on stock charts is the ability to take the RRG indicators that actually create that beautiful scatter plot and actually look at them as data series. If you watch Julius de Kempener's work or read his blogs, you'll see he uses this visualization often. I don't as much, but I thought this is a great way to show the weakness that we've seen in the XLK. Looking at the daily chart of the XLK, while NVIDIA and Broadcom and others are just breaking below their 50-day, Apple, Microsoft, and others have already done so. You can see that the XLK itself powering down through the 50-day and for now not stopping just yet. This is causing severe underperformance in the short term, I think, is part of a larger period of underperformance. And the RRG work is certainly echoing the fact that investors are rotating out of technology to greener pastures. Finally, we're asked a question in the mailbag about Boeing. We might talk about this a little more tomorrow, but shout out to one of the core companies based in the Seattle area. Boeing has had a pretty interesting run, and I would say accumulation phase from October of last year really to January, February. From there, more of a consolidation phase. And if you look from February of this year, really through July of this year, mid-July, consolidative, right? And you can see a rectangular pattern of consistent highs and consistent lows, bouncing off of support, bouncing down from resistance. That changed the gap higher a couple weeks ago, now following through to the upside. Charts that gap higher and then continue higher, bullish. Charts that gap lower and then continue lower. I'm looking at you, Apple. Not as bullish. Remember, what we do after that gap can be very, very important. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. We'll be back in the studio, all travel things working out okay. We'll be back in the studio tomorrow. Excited to get back to Redmond and continue with the show today, tomorrow, Friday, and beyond. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good one.